Hello, my name is Andrew Fake, and I would like to welcome you to our first online event of 2021, Mines and Money Online Global Precious Metals, helping to bring together investors, miners, and the industry together to discuss the latest opportunities and challenges in the marketplace. We have over 2,000 attendees signed up, and I hope that you find the event both informative, but also an opportunity to network and to do business. Each day, the meeting planner will be open 24 hours a day. If you've not logged in, please do so. It's a great opportunity to set up meetings over the course of the event. We have over 85 mining companies and over 400 investors attending, so there are plenty of mining investment opportunities. Mines and Money would like to thank our sponsors for the event, who are Dundee Goodman and IBK Capital, as well as the 85 sponsoring mining companies taking part. The conference features high-level content available both live and then on demand, including keynote panel discussions on precious metals such as gold and silver, mining pitch battles where mining projects pitch investors for their money, our ever popular 5 at 5 chat shows, and fireside chats with the likes of Frank Holmes, David Baker, Jake Klein, and first up we have Joe Mazumdar, editor of Exploration Insights. A brief background about Joe. Joe joined Brent Cook as co-editor and analyst of Exploration Insights in December 2015 and transitioned into being the sole editor a couple of years later. Previously, he had spent 6 years as a senior mining analyst at Hayward Securities and Canaccord Genuity and 6 years at Newmont Mining. Before becoming a mining analyst, he worked for over a decade as an exploration geologist. Delighted to have you with us here today, Joe.
Great. Thank you very much for the invite, Andrew.
Hey, thank you very much, Joe. And I'd like to kind of dive straight in. How well did Exploration Insights portfolio perform in 2020?
Oh, I mean, we had a good year, given the kind of year it was. I took off the names, but we have both the open and closed positions. So on the open positions, from when we bought it, and some of them, we made a lot of purchases. I made a lot of purchases in 2020 as well, and took advantage of the March fall in equities to purchase a couple of new projects, new companies. And so overall, it was about 70%. Obviously a big spectrum, but what I like to see is a lot of companies performing well, and only a few that, for other reasons didn't perform well. And so the first bar is how they performed in the portfolio, and the second bar that's a little bit shaded is how they performed versus the benchmark we use, because I constantly compare it to the benchmark as to see if it's just performing like the market or is it outperforming. So a 70% return overall. And then I closed a lot of positions, and some of these positions were in explorers that didn't generate any decent news flow or results. And so overall, the closed positions was about 40% up.
Wow, fantastic result there, Joe. As an exploration geologist spends a lot of time in the field, how did you adjust to the new normal in 2020 with a sort of like lack of travel going on?
Well, I mean, I would say that it was more of an adjustment for my wife and family, but but I would say, yeah, I mean, a normal year, I would travel at least once a month. So I would generate maybe 15 plus site visits per year. And the year before, in 2019, there were site visits to Mexico, Finland, BC here locally, Arizona, Chile, Japan, Ecuador, Bolivia, among other countries. And then this year, I got off to a good start, getting out to South Africa and Guatemala before PDAC. But after PDAC, I've only really had 3 site visits, all within Canada. And my last international site visit would have been to Guatemala pre-PDAC.
Okay, wow. I think I sort of spent like last Christmas there as well. That was probably my last travel trip before lockdown as well. So I guess sort of turning forward to 2021, what would be the big macro themes guiding your investments in gold and precious metals?
Before I go on there, I just want to add another point to the travel or the lack of travel, is that given the volatility of the market, sometimes when I'm traveling, it's hard for me to act on an investment, like to buy or to sell on news, because I'm in the middle of the field. This year, since I've been less traveling, I've been able to monitor the portfolio better. So that's just an aside as to an advantage, I guess, to the current circumstances.
Okay.
And with respect to the precious metal sector, I would say that last year we had a lot of negative yielding debt, getting up to 18 trillion by the end of 2020, and that's a big support for gold. And what we've seen is, this is probably my best graphic for showing the trends of how gold reacts. And so in March, when everything fell, when COVID-19 hit North America, even the gold price went down, but the TIPS rate, which this is the long-term inflation-adjusted treasury bonds, and you could see that they spiked up because of safe haven demand. But since then, as the TIPS rate went up from positive 0.6% to negative 1%, that's when gold peaked at about over 2,000. But since that time, when the trend is up, it doesn't matter if it's negative, but if the trend is going in an upward direction, then gold can suffer, which it did suffer after mid-August. But since then, we've had another decline down to minus 1% again before the end of the year. And that's what basically brought gold back up to 1,900. So this is something I watch every week to see how that's going. And it's not necessarily the absolute number with respect to the negative yield, it's the trend. And if the trend is going further negative, that's good for gold.
So kind of what's the sentiment for gold at the moment? Where do you see the price of gold going in 2021?
Well, I would say, like, if we go back to 2020, we had, negative yielding debt going to 18 trillion. We've had high volatility in the markets. We saw a weaker dollar after about March, which all should have been good for gold, but gold really only went up 25% last year. Even though it peaked in 2000, it came back down. And so one of the big things last year that may impact gold going forward is that some of the demand for gold is being eroded by Bitcoin, which went up, almost 300% last year. And so that's something that we got to watch. So we might have all the perfect support for gold in terms of market where people should be, gold might appeal as an asset class, but that might get eroded by Bitcoin depending on the sentiment towards Bitcoin as well.
Do you go and invest into Bitcoin?
I've done a little bit of Ethereum, but I haven't gone into Bitcoin, especially since it's gone up so much. I haven't gone into or invested in it. But I mean, we got to think that that the next generation, in terms of looking for this, asset class that's a good contrarian bet and doesn't correlate well with the markets. That Bitcoin might appeal to the younger generation more so than gold, and it's getting more liquid. It's getting more, time with respect to the, serious investors are looking at it. And so that's something that could potentially impact gold going forward. And the more Bitcoin gets popular, that could erode, the demand for gold.
Back to gold, what is the relationship between gold and COVID-19, which you've seen over the last year?
Well, I mean, okay, because this is good because the volatility in the market spiked, up to like 80 on the VIX around March. That's the same time we saw the TIPS rate go up and we saw gold price go down. And so when we saw the COVID cases, and this is the background here is the US COVID-19 cases, throughout 2020, and you can see the first wave, second wave, and the third wave, which we're in. But really, gold peaked when the volatility was actually coming down, and the cases were still in the second wave. And so gold's relationship with volatility and the underlying, impacts or what we've seen with cases in COVID, they're not correlated. What really is important is the impacts on policy, monetary, fiscal policy that generates, the negative yield and the trends to negative yield. That's really what hits gold price and changes the gold price. But in terms of overall, volatility or COVID cases, that really what we've seen in 2020 hasn't had a big relationship. Granted, it had a big negative relationship at the onset, just like every asset class except for bonds. Gold was negatively impacted, but since then, obviously, it did well until August. But again, that had no correlation with the volatility, market volatility, nor the cases in COVID, more of a relationship with the stimulus packages that were generated because of the, negative impact on the economy.
Mm-hmm. At this week's event, we've got obviously a lot of gold exploration stories. We've also got a lot of silver mining companies here at the event as well, probably more than ever before. And I guess linked to that, a number of investors I've spoken to believe silver will outperform gold in 2021. What's your view?
Well, silver is very levered to what happens in gold. So if gold goes up 1%, silver tends to go up 2 or 3%. So it's a very levered play, and the silver bugs, are used to that kind of volatility if it plays on the back of gold. But what silver has going for it that gold doesn't is that industrial demand, and that industrial demand is connected to the idea of electrification, lowering your carbon footprint in that. And so that underlying demand for silver could make silver have more support for gold in the medium to long term, just like it's driving copper, nickel, lithium, cobalt, and some of these other metals.
Mm-hmm. Obviously, sort of like one thing that happened that has happened in the last week, we've actually seen the Biden administration come into power. What's your view on the impact of Biden administration on commodities?
Well, I looked at this for our subscribers a couple of weeks ago. And so one thing right away on the mining companies that are located in the US, you will see a negative on their free cash flow because the corporate tax rate looks like it's going to go up from 21% to 28%. So at the end of the Obama administration, it was 35%. And then the Trump administration took it down 21%. And so Biden is taking it back up, but not all the way back up to the 35, but to 28. And so that negative free cash flow impact will obviously, it will be worse for US based companies like your Newmonts. We know that during the Trump administration, it was easier to permit projects, whether exploration development projects. Granted, that didn't help some, like the Pebble project in Alaska, and it won't. If there's a strong local, basically the lack of local support for a project, it won't get approved in any environment, or any presidency. But the permitting timelines themselves might be longer. And so that will be negative for development projects potentially, but also positive potentially for the price of the underlying commodity. Mm-hmm. Infrastructure spending, which is something that they've talked about for decades, if that ever happens, then yes, that's a positive for industrial metals like copper, iron ore, metallurgical coal for iron and other elements. The expansionary fiscal policies could be positive for gold and silver if they drive yields down. If the expansionary fiscal policies, if all they do is drive the risk on mentality for equities, that could have a negative impact on gold. Mm-hmm. And the other thing is investment in manufacturing that generates these local employment and high paying jobs. That's what mining is. And so if there's a good mining project that's permitted, that's doing well, and the locals support it, I think that's a positive for those guys. Mm-hmm. And the move away from fossil fuels, like I said, copper, nickel, lithium, cobalt, even uranium might be in the mix. Purchasing domestic goods might help some metals. It's definitely, encourage the strategic stockpile in uranium. And again, with the rare earth elements, the potential, for China, and they've done, is restricted exports of rare earths, and most of the rare earths are produced there. And rare earths are important for defense and other aspects of the industry. So that might build rare earth industry demand in the States. And another sort of, unknown is the U.S., not only U.S., but the global relationship with China. We've talked about, like just recently, China's talking about potentially another sort of Cold War on the economy or economic relationships with the U.S. going forward if the Biden administration continues the sort of policies of the Trump administration. So that animosity going forward is another uncertainty or variable that we got to look for in 2021 and going forward. But that variable does not only apply to US and China, it's also going with China and Australia, China and Canada, and with China and Europe has a different relationship because they just signed a trade agreement. So there are a lot of variables right now with respect to not only, because China is the biggest demand center for commodities, but the biggest consumer is still the US. And so if they can't sell their products into the US, there might be issues.
Will we see less reliance on China? Will countries like the US, Australia, and other countries rethink their mining supply chains?
I think the mining supply chains, definitely. But the issue is, if you say something like, oh, we've got a copper project in the States, that's good because, we need copper. But the problem is that copper is not going to become cathode in the States. It's got to be sent to Asia to be converted and smelted and refined and back to cathode before it gets back to the States and you convert it into rod or whatever. So until the US and North America and Europe as well start putting in more downstream facilities, they'll continue, especially the States and North America, to continue to ship their raw material to Asia, which is dominated by China, the raw materials, and then they won't even send you the cathode, they'd send you the end product. That's something that, the US administration and also most of the Americas has to think about going forward.
Mm-hmm. One of the big trends we've only touched on a little so far in our talk is obviously the rise of ESG. It's probably the big industry trend over the last sort of like 3 years. I guess I've got like two questions on that. First of all, how do you see ESG developing over the course of the next sort of 12 months? And I'm also kind of interested a bit back to your portfolio management. How does it influence your investment decision making?
Okay, for the first question, we are seeing a lot of these large funds, drive ESG policies within companies. And, because they're driving this policy and they're forcing themselves to buy these environmentally, friendly companies that, invoke all the social governance that they're imposing. They're driving up the price of those particular stocks. And so that index does better. The issue right now in terms of the mining sector, the question is mining actually compatible with these ESG investors? And so I took a look at this one analytics that they did on different companies. And so there was 108 companies, mining companies that they surveyed. 48 of them, like 44%, were considered severe risk in terms of ESG. Most of these are actually Chinese, like Zijin. The high risk ones, that's about 38%, include diversified miners like BHP and Rio Tinto. We're not talking about small guys, and gold companies like Barrick. And so some of the major gold companies, some of the major diversifieds are considered high risk. Mm-hmm. And we might be shocked by that, but if we go back to see what Rio Tinto had done in Western Australia with that Aboriginal site, then we'll say, well, maybe they're right. The low risk companies, actually happen to be the royalty and the streamers, because the ESG companies, the ESG investor doesn't make a connection between the royalty and the stream on the asset and the asset for the royalty and streaming company. Mm-hmm. So they actually score almost negligible, like Wheaton Precious Metals. The low risk companies, like lower than Barrick in terms of the gold sector, are Newmont and Newcrest. But going forward, our ESG conscious funds, which end up being the generalists and the big money, are they going to be investing in mining? And the issue is that if you don't have mining, you don't have some of this environment that you want, which is lower the carbon footprint, reduce greenhouse gas emissions because you need all of these metals. So they're going to have to get comfortable with the management teams that have to deal with the embedded risks of, remote assets that use diesel, water impacts, tailings, waste, all that other stuff. Because in the end, you cannot have this carbon free or neutral world in 2050 if you don't mine these metals.
Mm-hmm. Okay. And then just in terms of yourself and your portfolio, how well do you think the mining industry is doing at the exploration end? And have you adjusted your sort of like portfolio investments when you are looking to invest into exploration juniors?
Yeah, I know that some people think, well, the ESG really doesn't impact these juniors, because they're smaller companies and these ESG conscious, investors don't invest in these companies. The issue is that if you want somebody to actually buy that company, they have to follow the same ESG governance of the suitor. Otherwise, the suitor is not going to buy that company.
Mm-hmm.
And so more juniors are talking about ESG, not only because, that they want to get acquired, but because they have to do business. Then they've been doing it for a while, whether it's not going into remote communities right now and deferring exploration because of potential impacts of COVID right now. They talk about, social governance. And we've had, what we call a consulta previa or previous consultation with native groups as part of the United Nations agreements. They've been doing that for several years. And so a lot of exploration companies are on the cutting edge of these ESG issues, especially the way it relates to social issues and dealing with the locals. What they have to get better at is governance and potentially the environmental impacts of what they do, though they're not making as big as environmental impacts of a development company or a producer.
Mm-hmm. We're just going over like 2 to 3 minutes left, so I just want to quickly just turn to M&A. 2020 was quieter due to COVID-19. Likes of Peter Groskopf, who we had who we had at this event a couple of months ago, speculated 2021 would see a surge in M&A. Do you agree?
I mean, a lot of people have talked about a surge in M&A, and one of the reasons that we see that is that, if we just talk about the gold sector, this is a survey of about 24 companies, and BMO Capital Markets did this, and these companies have a cumulative market cap of about 200 billion. So they forecast them to generate 57% more free cash flow over 5 years, beginning in 2020, with a 23% increase in gold price from $1,500 to $1,850. So these guys are generating significant free cash flow. Their balance sheets are better. They don't have a lot of these write-offs anymore that they have to go through. So right now, with the current spot price being even below 1900, these guys are going to generate a lot of capital for potential acquisitions. And so we could see that, that wave of M&A because they're also looking to replace reserves, more so for the mid-tiers potentially. The issue right now is that we might not have, these travel restrictions being lifted until Q3, potentially at the earliest.
Mm-hmm.
And so those people that don't know the asset or don't know the jurisdiction and don't have any people there, that kind of M&A might be more difficult still. What we're seeing now is more relevant M&A via consolidation between companies that are working close together, either in the same jurisdiction or have a head office in the same jurisdiction, whether it's Western Australia. We see a Northern Star, and I think that was Northern Star and Saracen, I think it was. I can't remember.
That's correct, yeah.
Yeah, so we saw that one. We saw Alicer, SSRM, but they had a chance to do their due diligence before PDAC, and so they had it all sorted out. We saw Teranga and Endeavour, both those companies based out of Canada, all their assets in Western Australia. So that's an easy one to merge because you can do the due diligence, and also you can talk, one-to-one with the management teams. But the themes are the same. Basically, get bigger so you can get to a market cap where generalists would look at you, generate more cash flow so you could start issuing dividends, diversify your asset base, cut G&A, And the most important thing is generating free cash flow and getting to a scale where people are going to look at you. That's the incentive for M&A, but M&A is still going to be, I think, for the next few quarters, a little bit, hard to do, hard to execute because of the travel restrictions. But again, the M&A that can be in a place where people are already at, the management teams know each other, or they've already done their due diligence, those are the ones that probably have a higher probability of being executed in the current environment.
Thank you very much for your time, Joe Mazumdar of Exploration Insights.
Great. Thank you very much, Andrew.
Thank you.